Hello everyone, my name is Eugene and this is Finance Talk. Today we will speak how little indicator like debt to equity ratio can entirely ruin your investment. If you do not consider this indicator in your current or future analysis, you can partially or entirely lose money in your investment in the company. I believe that by knowing this information, you not only save your money today by rethinking about all companies you have in the portfolio right now, but also it will save you a lot of money in the future if you consider this indicator before your investment decisions. Stay tuned. But before we start, I will ask you to hit the like button for great confetti and subscribe to this channel for more videos. And now let's start. When you analyze the company before making the decision, you probably go through a lot of information about the business, about the competitors, industry trends, etc. You also probably go through indicators like PE ratio, free cash flow, the amount of debt the company has, and the amount of stocks the company issues every year. But another important indicator is debt to equity ratio, or DE ratio. It shows how the company is stable from the debt perspective. If the company doesn't have enough money to cover all its obligations for the long period of time, well, you understand what it means. It goes bankrupt. And in this case, if you are an investor in this particular company, you are not probably the first in the queue to take your money back. Maybe now you have a question. Well, I understand that this is important ratio. How do I calculate it? And the answer is pretty simple. You take the total liabilities of the company and divide it by shareholders' equity. Total liabilities can be found in quarterly or annual reports of the company in the balance sheet. You just go there and find this line. Shareholders' equity is usually the amount of money the company has in the end after paying all its obligations to creditors. To calculate shareholders' equity, you need to summarize these indicators. Or you can also go to the balance sheet of the company and find the total shareholders' equity line. There's also such indicator as long-term debt to shareholders' equity, which shows does the company have enough money to fulfill its long-term obligations. Now, how this information can help you to save and earn more money? If the indicator is below 1, it probably shows that the company has enough money to fulfill all its obligations to creditors. If it is higher than 1, this means that if something bad happens, the company wouldn't probably have enough money to pay all of its debt. This means that the management of the company can get more debt in order to stay competitive and earn less money in the next periods. The management can also issue more stocks, which can dilute your share as an investor, and you will receive less money. The higher the number, the higher the probability of company bankruptcy. Now let's talk about which numbers can consider good or bad. This information is totally based on my experience, and I do not claim that this is 100% right. Personally, when I analyze the company, I usually look at debt to equity ratio of 0.3, so 30%. It means that for every $1 of the asset the company has, 30 cents is debt. If the debt to equity ratio between 0.5 and 1. This is the flag for me that the company barely have enough money to stay competitive and pay all of its debt. And if the indicator is higher than 1, it clearly means that the company doesn't have enough money, and it would be the best for me. So now let's look on different examples of different debt to equity ratio. For that, I use two services. First, Wall Street Journal in order to look for financial reports of the company for the last 5 years. And second, finviz.com in order to get quick ratio of the current company. So if you look into liabilities of Apple company, we clearly can see that they have $125 billion in current liabilities and $119 billion in long-term debt. So we take total liabilities here, which is $287 billion, and divide it by total equity, which is $73 billion. And if you go to finviz.com, we can see that debt to equity ratio of Apple is 1.71. It means that if something happens today, Apple won't have enough money in order to pay all its obligations. But due to all the reputation which Apple has and all stable and future cash flow, because they have a recurring revenue from apps, they have recurring revenue from their products, which is coming out, for example, Mac, iPhone, AirPods, etc. They can actually have this number, and this is not critical at all. If you go to different company, for example, Accenture, for those who don't know, this is the company which provides different web services for S&P 500 companies. This is usually web development, consulting services. We can also see that they have total liabilities of $23 billion, and they also have total equity of $20 billion, which gives us approximately 0.9, 0.85 in debt to equity ratio, which is not so well, but this is the software company. They do not have any huge capital expenditures like Apple has. So in this case, this indicator can also be qualified as stable. Next, we have IMC Entertainment. This is, as you probably heard, one of the meme stocks, which has a lot of debt in their balance sheet and not stable cash flow. So in total liabilities, they have more than $12.6 billion. And in total equity, they have minus $1.7 billion. When the equity is negative, this means that you as an investor lose your money by buying this stock. As we can calculate, this company has negative debt to equity ratio. So if we take this indicator into consideration, this company should be the best for future investment analysis. So now you pretty much understand the concept of debt to equity ratio. I personally think that this is one of the most important indicators before making the investment decisions. And it is definitely in my investment checklist. If you do not know what the investment checklist is and how it can improve your investment process and make it easier, here is the video which can show you the concept. That's all for today. I hope this video was useful for you. If so, please leave a like, and as usual, subscribe to this channel for more great videos. Bye.